My sense is gold will trade to 3,500. It's the when that I'm a little bit more conservative than other analysts. Right now, I'm looking at the top potential top of gold. And this, of course, our calculations done before the fall, but they're still relevant. Anywhere between 3,350 and 3,400 an ounce. 3,500 an ounce, if I had to calculate, I would have looked for a second quarter next year. It's not a matter of if, but when, because I believe that that's truly a logical price level for gold to ascend to, all things being equal.
Spot gold hit a record high of $3,167.57 per troy ounce, marking a 16% rise this year and building on the 27% growth in 2024. While the market's path may not be smooth, analysts suggest that gold's current rally appears more sustainable than its surge 45 years ago. GaryWagner, editor of thegoldforecast.com, remains bullish on gold's long-term prospects, predicting that prices could reach $3,350 to $3,500 by mid-next year. Gold continues to be viewed as a reliable hedge against uncertainty, inflation, and falling equities. The recent surge in gold prices has drawn comparisons to 1980, when political and economic turmoil pushed gold to record highs. However, analysts argue that this current rally differs from past rallies. Unlike the coordinated efforts of global powers to resolve issues in the 1980s, today's geopolitical tensions, including U.S. tariffs, trade conflicts, and ongoing wars in Ukraine and the Middle East, make a quick resolution unlikely, which could extend the rising gold prices. The recent rise above $3,000 per ounce, spurred by President Donald Trump's new round of tariffs, highlights the significant role of geopolitics and economic uncertainty in the gold market. According to HSBC analyst James Steele, this is the first time in a long while that these factors have been the main drivers behind gold's price movements. While gold and U.S. stocks have recently declined, Wagner expects gold to find support first. Unlike the sharp drop in equities, gold's recent pullback appears more orderly, with early signs of stabilization. Looking back at the period from 1971 to 1980, when gold rose approximately 2,300% while the Dow fell 25%, the surge in gold was driven by the end of the Bretton Woods Agreement, stagflation, and high geopolitical tensions. Today, similar factors drive interest in gold as a safe haven asset, positioning it for continued growth in the face of uncertainty. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
My sense is that will definitely happen, in that gold will recover before U.S. equities do. They're trading in tandem lower, but the first of those two asset classes that will find support, unquestionably, in my opinion, is going to be gold, not equities. In other words, equity is not going to get a soft landing, find support, and begin to move higher, but gold continues to slip lower. I don't see that playing out. That's not as probable as gold finding support with equities continuing to decline, hopefully slowing down the pace at which they've declined, because this decline has been exceedingly quick. It's been a massive amount of damage, but over 3 days. When we look at other corrections in U.S. equities, they typically take a little bit longer to have an equal amount or an equal percentage decline that we're witnessing now, much more than 3 days. So now we've converted our daily to a 4-hour chart and included Elliott wave. And if we look at Elliott wave counts on a daily chart, we're still fully embedded in that final fifth wave. And the correction, of course, has begun, but it's not really giving a wave count yet because it's only been 3 days. But here you see that on Wednesday, the 2nd of April, we hit a 5, 5, and 5. So on every time parameter, these are different parameters of days longer or shorter. It began an A, a B, and a C correction. Typically, we use the 4-hour charts because they're going to be much more sensitive to tops and bottoms, key reversals, than the dailies, just because they are shorter time cycle and therefore will give you that indication much sooner. But we are getting indications of the potential for a bottom. You can see that we do have a green candle that formed. This would be called a piercing line in terms of candlesticks, but we also saw it here and here. So the A came down. It tried to sustain a upside move, was unsustainable, sold off to form our B wave. and now it then moved up for our B wave and now down to our C wave here at about 29.70. So that's the key line in the sand that gold needs to hold in terms of June futures. If it can hold that and it begins to trade sideways, or we get more bullish momentum, such as the next few candles are green with a higher high and a higher low, we would call that a confirming candles that are confirming that this, in fact, is indicating that support has come into the market. What was most interesting to me is as I watched the market trade overseas yesterday in Hawaii, of course, which is Monday in Australia, there were points at times when it really appeared as though there was some sort of recovery that was actually occurring. However, it was unsustainable. We saw that again today. We saw that last week. So we have a market that is going counter to the fundamentals that it would typically have. This is when you would look to utilize gold as a safe haven asset to protect the risk on, risk off, to protect the price decline of U.S. equities. And yet it moved in tandem. And so there's going to come a point when you get the true disconnect and gold begins to act as a safe haven. I would imagine that could occur early this week.
Gold's recent correction has been relatively shallow, with key support levels continuing to hold firm, particularly the trend line from the January low near $2,975 and the February highs around $2,955. These levels suggest underlying strength in the market, even amid recent volatility. Global stock markets have sharply hit following U.S. President Donald Trump's continued push for sweeping tariffs. In response, China imposed retaliatory measures, including an additional 34% tariff on all U.S. goods and new export restrictions on certain rare earth metals, escalating fears of a prolonged trade war. Despite gold's reputation as a safe haven asset, it hasn't performed as expected in the face of recent market turmoil. GaryWagner notes that gold sold off alongside equities instead of rising. During intense equity sell-offs, gold can initially drop as investors liquidate assets to cover losses elsewhere. However, historically, gold tends to find support more quickly than stocks, reaffirming its longer-term role as a hedge against uncertainty and economic instability. Let's get back to the interview.
Is it a safe haven now is the appropriate question, and you have to say, no, it's not acting like that. And we've seen this before. We've seen this when we've had massive equity sell-offs that spilled over into other ancillary asset classes that weren't related to the equities. We've seen gold sell off. And what we saw last week was largely, I believe, either profit taking in gold and using that to cover margin calls or to add liquidity. People were liquidating. It was a fire sale. When you have that kind of brutal price decline, portfolios are getting hammered very quickly to a substantial degree. You want to raise your level of liquidity. You want to do whatever you think is necessary to protect it. Now, is it the best move? Well, I don't believe that that's the way it should go, but it has done this in the past. In that way, it does not surprise me. But what we also saw in the past is that the fact that they would run in tandem, gold would tend to find support much earlier than the actual meltdown in equities came to a conclusion. On a technical basis, it hit that and it became the record high. It was unsustainable. And more importantly, it came down fairly hard considering that, well, it just moved back up over 3,000, but this morning it was trading below $3,000 per ounce. So we're looking at it kind of skirting that area. But when you think about it, on Thursday, gold futures declined by $50. Friday, $82. Today, $60+ We've had strong declines with substantial volume for the last 3 trading days. And it's in unison with the equities that are under pressure. And I'll show you an interesting observation when we do look at some charts about the S&P, the NASDAQ, and the Dow in terms of, even though they're lower, how they look in a candlestick format, an unusual scenario. So my sense is that at some point, I believe that it will hopefully occur this week. You will see gold begin to disconnect from the selling pressure that we're seeing in equities. And at that point, people will return to that as a safe haven asset to protect the portfolio that's getting hammered by components within that, which specifically are the stocks they own. The first thing that I want to look at is short term, and then we'll look at longer term charts to where we think we could find support. This is a very short term chart, 5 minutes per candlestick. The candlesticks are also candlesticks with volume. That's why you see some wider and the corresponding volume below it. What is so interesting is that we saw this last week where we would get tremendous selling pressure. So the open on Monday, really, this is Australia's Monday. It takes it from $3,058 down to lows just below $3,029.88. And then you've got this long consecutive series of green candles with strong volume that move gold back up to $3,075. Definitely countered the trend. And then you had a slow and methodical price decline for a period of hours. And that is kind of interesting. So you make this next low that comes in, makes it slow, and then it spikes back up. But that is a false spike in that it was a counter trend that you wouldn't expect and also unsustainable. And then you return, you make the lowest low of the day. And now we're sitting just above that, right around 3,000. So on a short-term basis, we've seen selling pressure. The selling pressure remains, but we're also seeing points when there is either an attempt to recover or people squaring positions off. But it's interesting. It's not just straight selling with small kicks to the upside, so to speak. Typically, it's a stair step. It'll move down 3 steps, move up 1, down 3, up 1. This, it moved down 1, and then it moved up 1.5. Tremendous spikes with a counter trend on a short-term basis. Now, we also saw that in equities, and that was due to a rumor that began to circulate that said that they might have a 90-day pause on the tariffs. So equities shot up, and the White House announced that that's not true. Equities returned to their selling pressure, and so did gold.
With escalating global tensions and renewed economic headwinds, gold's trajectory reflects its enduring role as a strategic asset. Despite recent pullbacks, the resilience at key price thresholds suggests that investor confidence in the metal remains firm. As broader markets waver under the weight of policy shocks and trade uncertainty, gold is increasingly viewed as a hedge and a foundation of stability in a rapidly evolving financial environment. Given the current climate, could we witness the early stages of a paradigm shift where capital flows more consistently favor defensive hard assets over traditional risk markets? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.